Welcome to today's 7 and 7 show with Zach Ellison. Today I'm joined by Michael Furla, CFA, CFP, who is the head of fixed income and the co-head of the investment department at the Mather Group in Chicago. Michael, thanks for joining today. It's great to have you.
Happy to be here. Thank you for having me.
So before we dig in, tell us a little bit about your background in the Mather Group.
Absolutely. So I joined the Mather Group in 2017, co-head of the investment department. We are a $9 billion RIA multifamily office, which focuses on providing high net worth and ultra high net worth individuals financial planning, investment management, tax strategy, and estate planning services. We have 15 locations across the U.S., and we are headquartered in Chicago. And then regarding my background, I started out my career at S&P Global Ratings as a muni bond credit analyst, where I helped construct the muni bond rating calculation engine that would assign state and local government ratings to city and county in the United States. And then I helped them build out their internal surveillance system, which would identify credits that had a high probability of an upgrade or downgrade. I then went to Morningstar thereafter. I did similar credit work, but for global corporate debt, extrapolating ratings from rated entities to non-rated issuances or bonds based off the capital structure or private claims. And as I mentioned before, thereafter went to the Mather Group in 2017.
And Mike, last time we were on a panel together, I think it was last year in person. And at that point, you guys were at the Mather Group were going quite quickly, and it's gone probably even better than expected. You're almost 10 billion now. So congratulations on the growth. What's driving the growth, do you think, mainly?
I would say first and foremost, really good team and leadership. We always have a team mindset. When I joined the Mather Group in 2017, we were managing just under $1 billion in AUM, or assets under management. And we've almost 10x'd in the less than 6 years. So really we have that really great individuals. We work as a team. A lot of hard work, blood, sweat, and tears. We're coming in early, staying late, working weekends, but we're doing it for our clients, and we're doing it to try to make our mark in the industry. It's been really exciting. The way we describe it is the Mather Group is a rocket ship, and we're trying to hold on and propel it forward. And it's been quite an exciting experience.
It's great to watch it. And I think a big part of it is how closely you work with your clients and get them access to differentiated strategies in fixed income as well as other asset classes. What are your clients asking you about these days? Because there's so much going on in the markets and so much volatility, so much risk. I'm very curious what your clients are asking.
We are getting a lot of great questions from clients. We're getting questions about inflation. We're getting questions about the debt ceiling. We're getting questions about the regional banking crisis. We're getting questions about China, Taiwan, Russia, Ukraine, the US dollar strength. And we've provided some thought leadership pieces addressing each of those topics and issues. And the future is inherently unknowable. It's hard to know what will happen, but what we can do is look at past cycles and empirical data to make better informed decisions to make sure we are well positioned for whatever may come our way.
But when you think about past cycles with interest rates, are there certain periods that you're looking at that you can learn from to use today?
Yes, if you look at past eras of elevated inflation, you can look at the 70s, early 80s, where we had the Volcker come in and raise rates well beyond where they are today. We can identify there's certain asset classes that tend to be more resilient to elevated inflation and rising interest rates. And then there's other asset classes that are more susceptible to it. Right now, we're looking at, commercial real estate, they're taking a hit right now. There's certain assets that are just very tied to the discount rates, which allows for their pricing. And it's just looking across all asset classes and geographies as well, to identify how to bring in a little bit more diversification or create a balance in the portfolio, which usually bonds are.
And when I think about fixed income performance, there's interest rate risk and there's also credit risk. It seems like a lot of people forgot about interest rate risk somehow and have gotten hurt quite badly because of that. Many so-called professionals, in fact, many of the banks that are now going under didn't know how to manage rate risk. So I wanted to talk to you about how you think about managing interest rate risk at a portfolio level and how you think about managing it through cycles. It's easy to manage rate risk if things aren't changing, but if we're going to a different paradigm shift, which is happening now with much higher rates and much higher inflation, obviously, how do you construct a portfolio that's all weather and durable through multiple cycles?
Great question. And to touch upon your earlier comments about how some of these regional banks did not manage their duration risk. There was a mismatch with their asset liability matching. You have these deposits and then they have these long-term investments. And the Fed increased rates 5% in less than 18 months. And what happened is if you have long-dated agency mortgage-backed securities or treasuries, which they had both, and let's say the duration is 10% on that, if rates go up by 1%, given that 10 duration, the price of the portfolio, given the inverse relationship, will fall by 10%. And that's what they experienced. And while they had them marked as held to maturity, they had enough deposit withdrawals where they had to reclassify their balance sheet for some of those assets from held to maturity to securities. And then they have to actually realize those losses. And then that's what spurred the fear, the bank run, and the rest is history. So as you mentioned, the two main risks or factors when investing in fixed income and creating fixed income portfolios are duration or interest rate risk and then credit risk. Obviously, you have to look at both. Going into 2022, we felt with rates so low and the Fed telling us, hey, we're going to raise interest rates. We have a terminal rate above 4.5%. We decided to take our duration short and to mitigate the rising interest rate. So in a rising interest rate environment, it is advantageous to reduce or be underweight duration to mitigate that price hit you'll take on your bond portfolio. That's where we are today. However, though, if you look at various studies, once the Fed's near the end of the rate hiking cycle, usually right around that last one or two rate hikes, it makes sense to actually increase your duration back to neutral. We believe, and I believe that's where we are today. Given the Fed's most recent comments, they may be entering a period of a pause, review the data, and see if we're at that terminal rate or maybe if we're right almost there. But getting back to neutral near the end of a rising interest rate environment is advantageous because let's say, as the Fed historically has, they overhike and they have to drop interest rates and yields compress or fall. If you have fixed rate instruments, you want to make sure you have neutral or even long duration. So as rates fall, bond prices rise, and you get that ballast or diversification benefit of the portfolio. If you're short duration, it paid off in 2022, but if rates fall end of 2023 or in 2024, you're going to be caught off and you're going to underperform on the price side of the return for the total return of bonds, price and income. So, and then credit, as we mentioned earlier, that's quite important. And during the end of a rising interest rate environment or a rate hiking cycle, you have to be really careful with spreads, especially high yield. Right now, they're a little bit tight. And the Fed is increasing rates to diminish demand and to diminish inflation. They're intentionally trying to slow down the economy. When you're slowing down the economy, you potentially have lower corporate earnings or profits, you have higher unemployment, and you have more risk or credit risk with these companies. And especially if they're borrowing, their leverage, the cost of it's much higher, the cost of capital. So with that, in this current period of near the end of the rate hiking cycle and near the end of a rising rate environment, it makes sense to go up in credit quality. You want to make sure you're not going too down on the credit scale because you will see elevated defaults moving forward. Because if there is a recession, whether it's mild or hard, however you want to classify it, there will be more businesses failing, and you want to be on the right side of that trade.
Great points. And I think a lot about risk first and moving up in quality, like you said. And some of that also comes from the structure of the deals and the seniority of the loans. So being in senior loans that have a lien on all assets, hopefully a first lien, that's very nice. And keeping loan to value very low on loans is also important. How are you thinking about fixed rate versus floating rate securities at the moment?
Absolutely. I would say most of our fixed income portfolios are constructed with fixed rate. Now we do have a little bit of private credit exposure, and that has been expanding because, as you've seen with the banking crisis, credit is getting tighter. They're getting away from the space. There is less players. There's less loans. So there's going to be a mismatch between supply and demand. And with that, with the right type of lenders and with the right type of structuring, as you mentioned, there's going to be a great opportunity for private credit moving forward as banks exit this space, whether it's regulatory or they're just forced to based off their balance sheets. So we're quite excited for the space, but you do have to be careful. You have to make sure you're investing with the right managers, the right lenders, good businesses that have substantial collateral and good cash flow and are resilient to economic downturns.
But what are the other core investment principles that you think about that serve you well through all cycles?
I'll have to think about that one for a second. In general, it's hard to time the market. When you try to time the market, you have to be right twice. You have to know when to get out. You have to know when to get back in. We believe, and I know Warren Buffett says this, it's about not timing the market. It's about time in the market, long-term investing, being fully invested in the market at all times. With that, we do make some minor tactical shifts, whether it's duration, credit quality, kind of put our thumb on the scale to try to add a little bit of alpha where it makes sense. We conduct evidence-based investing, and when we look at efficient markets, we believe it's best to get, control the controllables, reduce costs, and your taxes, your tax liability after tax returns. So when we look at inefficient markets, that's where we will go beyond indexing. And if there's a higher probability of outperformance because these markets are less efficient, we believe there's an opportunity to add value there. So regarding the cycles and the timing and all that, we want to make sure we look at factors that have persistence over long periods of time. And you want to have exposure to those factors before every point in the cycle, because usually once the cycle turns, you're too late to the party. It's not going to pay off. You have to be positioned correctly before changes occur.
Great points. What are some of the products that you like right now in fixed income? We talked a little bit offline about bond ladders and private credit. How do those work?
Absolutely. So we believe it just depends on each individual client's needs. If they don't need as much liquidity, we can do bond ladders. If they have sizable assets, we can move our way into private credit since they don't have that cash flow need for multiple years. But what we like to do, our preferred method, is to have bond ladders, whether it's treasury bond ladders, investment grade corporate bond ladders, or if they're in a higher tax bracket and they're in a state such as California that has a high state income tax, tax-free municipal bond ladders. And what we do is we have those as the core positioning of the portfolio, and then we add additional bond ETFs or mutual funds around that as levers. So if we want to adjust duration, we can use these ETFs to increase or decrease. If we want to adjust credit quality, we can use those ETFs to increase or decrease. If we want to overweight, underweight different bond classes, let's say you're a taxable fixed income investor, you have exposure to, let's say, the ag, so it's about 1/3 treasuries, 1/3 investment grade corporates, 1/3 agency mortgage-backed securities. Let's say you want to underweight agency mortgage-backed securities because the Fed was one of the biggest buyers in the space, and they're letting that roll off their balance sheet. And you believe that there'll be an influx of supply, which will impact negatively the pricing. We can use ETFs to decrease that exposure from bond class perspective. So that's really our thought. And we believe in global diversification. So while we have a majority of our fixed income assets, US based, we do invest in emerging market debt and developed international debt. But all of the international exposure is US dollar hedged because we're not trying to create foreign exchange risk. I know we were going to talk about what would keep me up at night, and currency risk would be one of them for some of these emerging market countries. Not trying to deal with that. It can change really quickly and it can get real bad real fast. So hedging your bets is the way we prefer to invest.
And you made a good point about a diversified portfolio that includes other geographies outside the US. And also, of course, you're investing in private credit, which is very different in many respects versus public credit like corporate bonds or treasuries. What do you like about private credit right now, given all the bank failures we're seeing, which is going to pull back bank lending and create more opportunities for non-bank lenders?
Exactly. So I know we touched upon this briefly, but with banks pulling out, those regional banks especially, there's going to be less players in the space. And with that, in past years, when public fixed income markets, when the yields were very low, these pensions, endowments, foundations, they had to go out on the risk scale. So they went away from public fixed income instruments towards private credit. And since there's a lot of demand to own that, it really drove down the yields in the space. Now that public fixed income is providing, you have treasuries yielding, north of 4%, 5%. You have more options. So with that, there's less demand in certain areas, which means there could be higher yields. And also because there's less lenders, they can demand a higher return. So the supply demand dynamics make the private credit space more attractive moving forward, because there should be a higher demand for, with the less suppliers or less lenders, there'll be more opportunity to ask for a higher return by investors.
Those are great points and match with what we're seeing in the market on the venture debt side. For those that don't know, Silicon Valley Bank, which was one of the big bank failures, and some of the other regional banks were the primary capital providers to startups by providing them with loans. Unfortunately, SVB and others failed because they had interest rate risk that they didn't manage properly related to treasuries and mortgage-backed securities, which is kind of ironic because a lot of people, when I mention venture debt, will say, well, that sounds risky. But 3 of the 4 largest bank failures in history happened in the last 2 months, and it had nothing to do with their loan books. It had everything to do with their treasury exposure and their mortgage-backed exposure, which technically don't really have credit risk, but they have a lot of interest rate risk. So it just goes to show that there's a lot of opportunity right now because of the lack of supply, like you said, Michael. And yeah, I think within private credit, there's various niches that are really attractive. Are there any that you've been looking at, and including venture debt, that are a good match for certain clients, particularly maybe family offices or ultra high net worth?
And I do want to touch where you mentioned there is this belief, and technically the U.S. Treasury is the risk-free rate for all financial assets globally. But as we know, there's this discussion about the debt ceiling. Right now, we're utilizing extraordinary measures to fund the government, and that will run out shortly, while in 106 years since we've had a debt ceiling. We've raised it, I think it was around 98 times, almost 100 times. Given the polarized government, there's increased risk of, if they don't raise, extend, or remove the debt ceiling, that risk-free asset could potentially default. And there's some that say that we've never had a default before, but in I believe it was 33, technically there was, we could argue, a default on some payments by the U.S. government. And then in 1971, when we went off the gold standard, you could argue that that was reverting back on a promise. And then in 19, I want to say 77 or so, that was another time where it was actually treasuries. There was a missed payment there. So there's been multiple occurrences where we've had, maybe it's not, historians will argue if it's a true default or if they, how do you call it? If they alleviate the situation within a, fairly short time frame, but it is a possibility. So even the arguably risk-free assets of treasuries and agency mortgage-backed securities aren't truly risk-free. There's risk to anything. So I just want to make sure investors are aware of that because, there's no free lunch. And we really have to identify the risks out there. And with the debt ceiling, there is that new risk that's elevated compared to prior years. Look at CDS on the situation, and it's elevated compared to prior situations. Regarding venture debt, where the opportunities are, we just want to make sure we're more industry agnostic. So it's more of identifying companies that will be lent to that have healthy balance sheets, that have cash flow. We're not looking to obviously with, venture, earlier stage and you're trying to grow that revenue. But we want to make sure that there's decent cash flow and the structure of the loans are advantageous, whether it's the covenants or just the amount of collateral. So really, at this time, we're really looking at structure versus specific segments of the market, sectors or what have you.
Great point. I think structure is often overlooked when people think about how to succeed in fixed income. And they think about interest rate risk. Well, some people do. Clearly, not enough people. but a lot of people think properly about interest rate risk and credit risk. But in private credit, deal structure is the huge risk mitigator. And having ample asset coverage, being senior in the capital structure with a lien on assets, having very low loan to value, having strong covenants. These are things that can take a good company and make it a great deal. And conversely, what we saw in 2021 when a lot of people were putting money to work was the opposite. You took good companies and put a bad structure around it to win the deal. And now you've got fairly risky credits that were also priced too low during 2021 and 22 to some extent. So it's something we think about a lot, is how to structure a good company. And that really is a huge risk mitigator. So we're about out of time. What are you thinking about in terms of the key themes we should be left with? Just before you answer, I'll summarize a couple that you talked about. Moving up in quality is key. Thinking about diversification across products and across geographies. Thinking about the fact that treasuries aren't necessarily risk-free. Certainly not interest rate risk-free, and also perhaps not credit risk-free as well, given the situation with the debt ceiling. What are other things we're missing that we should think about?
This goes back to Howard Marks. He has a approximately quarterly memo, and on December 17th, I believe, 2022, he had the Sea Change memo. And it's really the investor psyche, which is so important. I'll just provide a high-level overview. From 2009 to 2021, the investor, it was about FOMO. It was risk-taking. It was below average inflation. It was historically low interest rates. It was fear of missing out. Capital and credit was plentiful. Now, in 2022, 2023, and beyond, it's not about fear of missing out. It's risk aversion. Inflation is elevated. Rates are higher, more normal. Credit is tighter. Capital is less plentiful. Risk, people are investing based off of, considering more risk factors now. So it's a shift in investor psyche that's really important to note, that we're entering this new regime of somewhat risk aversion, and it's something that we should consider. So as we deploy capital, we have to be really cautious about where we're putting it. And since there's potentially not as many opportunities as before, regarding how you receive capital to invest, you have to make sure every dollar that goes out, you're very thoughtful in where it goes. And the last decade, they said the income was missing in fixed income. I'm happy to say it's back. So now, whether it's private credit or public fixed income instruments, you can get decent income now. So equities and risk assets have to compete more. So we'll see more of that moving forward over the coming years.
Well said. Michael, thanks so much for joining today. It's always great talking to you. And hopefully we can get you back later this year and get an update on all the things we talked about. And thanks everybody for listening and watching, and see you next time on the 7 and 7 Show.
Thank you, Zach. Have a good one.